Nope, I'm not getting up. This is a passive video. We are laying back for this one, just like the market, okay? Just put more money on my table. That's how it works, right? What do you mean that's not how it works? Passive investments are huge. They've taken over half the market. Well, that's what the story is. Let's actually get to the facts underneath this story. You may have heard over the last year that passive investing has taken up half the market. Can you believe these index funds? Well, there's a little truth in that, but not nearly as much as it is. And is it actually a problem like people think it is? Well, let's get into it. First off, I need to dispel a rumor. Passive investing is not half of the market, okay? Index funds are about half of the market. But just because you're an index fund does not mean you're a passive fund. There's a lot of funds that are actually active. About 16% of the stock market is made up of active index funds. I know, crazy. The real number of passive funds is actually in the 30s, about a third of the market, okay? So that's still a tremendous amount of people who are just saying, Vanguard, State Street, BlackRock, take that and make it more. I don't care. I'll come back in 20, 30 years, okay? But honestly, a low-cost index fund is a good investment. You should hopefully get between 8 and 10% a year. I like to usually say 9 to 10, but honestly, some of these guys, they've been managing it pretty poorly. So let's drop it just a little bit and say 8, but look, 9 to 10% fairly reliably over a long stretch of time. In 1 year, they may do 20%, they may lose 60%, okay? The market can be very volatile, but over the very long term, it averages somewhere in that range. Let's call it 9%, all right? So, is this a good thing? Is this a bad thing? Is it kind of both? Well, let's get into it. All right, so it's great that people can now access relatively safe investments that over time will go up. Now, some of this going up is due to inflation, but hey, that's how things are. But some of it is true real gains, especially the US stock market. It's been doing pretty well over the last 100 years or so, minus a couple blips here and there that come up every 10 years, or more regularly sometimes here lately, it feels like. What's the big deal with so many people putting money in these funds that are passive? Well, it's nice and easy, and they let somebody else manage it for them. And they follow a formula. It's real simple. There's just one little problem. The more money that gets put in this, the less people are out there looking and doing price discovery. There's less people going, hey, I actually think that company's not correctly valued. It's overvalued. It's undervalued. And like actually doing the work in the numbers. Nobody's sitting there and doing their homework and going, is that company really worth 50 times their earnings, 200 times their earnings? I mean, they could justify it. They just got to grow the size of, the 15th biggest country in the world to justify that in terms of like reasonable earnings. I'm sure they can grow by a massive country size every few years. Yeah, that's doable, right? Maybe not. And a lot of times you'll see people getting absolutely phenomenal returns by leaning in and doing their homework. You can see people like Michael Burry or so many other over the years that have found something and they're like, hey, why is nobody seeing this? Why hasn't somebody jumped on this? And maybe they will eventually, but only after everybody else has really gotten in there that's going to get in there early. We need more people looking, doing the hard work. Unfortunately, most people don't want to. They're looking for the easiest thing. We'll just collect some fees. We'll deploy the capital in the average way. It's fine. As long as we're kind of close to what the market does, nobody's going to care. That's the philosophy that's going on. Now, I do have to say there are some great people out there, like the people at Muddy Waters. We appreciate you guys very much. You do a great job. We really like reading your research reports, by the way. Fantastic. They're out there. They're finding frauds and malfeasance all throughout the stock market. And man, oh man, is there a lot of it. And they bring this to light and try and correct the share prices to what they should be. They go out there, they take a short position, and they say, we think that company's lying. Here's our evidence. Market, decide. And a lot of times, they've uncovered crazy things that just are unbelievable that they got away with it for so long. And so it's been really good having a few good people like that in there to be like, hey, that's overvalued. You guys are going to lose money. Let me show you how, and fixing things. And there's also people out there going, hey, this price to earnings and stuff, like, guys, this is a good buy. I mean, Warren Buffett kind of used to do a lot of this. He's kind of dialed back over the years, but he goes out there and he's like, hey, I did the math. Wells Fargo today, it's cheap. Let's go get Wells Fargo. This is not me endorsing Wells Fargo, by the way. Also, don't buy banks or anything, especially if you don't understand how they all work. Please do extra due diligence on financial companies. Speaking of financial companies, though, the reason that is one of my default examples when I'm talking about this is because a lot of these passive index funds, they don't include financial companies. Now, there's a whole list of reasons why they're specialized. You really got to know extra stuff. But because they're not included in these passive index funds as often, they still are, just not nearly as often, they don't get as inflated as the rest of the market. So a lot of times you'll be going out there and oh, this company has a price to earnings of, some ridiculous number. Their PE is 20. Oh, it's 30. It's 40. And you might find a financial company and you're like, that's 8. That's 10. Oh gosh, this one's highly valued. It's like 14. The historic average used to be 15, guys. It's trading at a discount. And it's doing this because a lot of people are just throwing money in these passive funds. It's pumping up the rest of the market. And anything that's not included in one of these funds ends up not getting this inflated valuation of dumb money. And look. If you're just starting out and stuff, yeah, it's a really good idea to use a passive index fund. I love passive index funds. I have some, okay? I also have ridiculous triple leveraged index funds that I do crazy chicanery with. So you guys got to figure out what works for you. But what you don't need is to get on the hype train and assume the market is always right. Because there's a lot of people out there worrying right now that there is an index bubble. And eventually it's going to pop. It's going to realize, oh, all this money that we've been pumping into some of these companies, maybe this company's not worth $2 or $3 trillion. Maybe it's only worth a few $100 billion. That would be a very bad day for a lot of people. And if nobody's looking, this could happen. Now, it may not be happening at this very moment, I hope, but it's very possible. And the more and more people put money into passive index funds, the more likely it is to happen. I know, we got a conundrum here. It's not a terrible idea to put your money in a nice, safe, passive index fund. But the more of you that do it, the riskier it becomes to do it. Got a bit of a problem there. So, you should always make sure to diversify your portfolios, okay? Don't put all of your eggs in one basket. Just because you got a good index fund and you're like, yeah, no, the market's going to be fine. No, have something else in diversified assets. I actually like crypto for this. It lets you access a whole bunch of different kinds of assets and keep it all in one convenient place for you. It's really hard to have all your assets, like your dollars and stuff, and your real estate, and various stocks, and various crypto all in one place. But you know what? In DeFi, you get to do that. If you want real estate access, bam, you got the OREE token. You want gold? There's so many tokenized gold things. There's Pax Gold. Heck, we're coming out with a tokenized gold. All right? You can get your precious metals in there. All right? You can't do that at most of your brokerages. Now, you want your cash? You want your cash for your daily expenses? Bam, put some stable coins in your wallet. All right? You can put those in Aave or any other money market fund. Heck, you can put it in the Overlord Club and have 20% coming in on your cash, all the while expense, bam, paid. Just like it's coming from your bank. It's even insured at the Overlord Club. Now, you can get all the exposure you want to more assets than are available on the average stock market or any brokerage you can possibly find just by accessing crypto. This is why I'm such a big proponent of it. I know, you got the dog coins, the monkey pictures, and so much shenanigans that it's just terrible, all right? You got celebrities putting out absolute garbage. There's a lot of stuff you got to watch out for. That's why you really got to pay attention. That's why we've made this whole series of courses so you can learn what to do, what not to do, and the obvious signs of something you should or should not get into, all right? We don't want you guys getting hurt out there, and I'm a little bit concerned that this whole index bubble might just pop, all right? Might not happen today, might not happen next year, but could it happen by the time you're retiring? Well, I sure hope not, but it's certainly possible. Just a few years ago, index funds were like 3% of the market. In 2000, it was like 3 and change percent. Now, it's a third. Where will it be in 10 years? 20. You're retiring in 30 years? Where do you think it'll be then? Please, guys, be careful. Don't just assume you can set and forget. Certainly not with the same strategy everybody else is doing. Because you know what? Average guy right now, he doesn't have $500 he can get in an emergency. Do you want to be the average guy? Do you want the average return? I mean, if you do, go for it. But please, please, try and do better than average. I know you can do it, and I would love to help you do it. So come join the Overlord Club. We'll help you get there.